Hello everyone, welcome to lesson 6. This is the final lesson in module 2. If you have not yet had a chance, I recommend going back and watching lessons 1 through 5 just so you really know what is going on, just to catch up. But if you're joining us for the first time, my name is Dr. Kevin Schuford. I have a Ph.D. in communication and I'm also a licensed realtor and mortgage officer in California and Arizona, and then have referral partners across all 50 states and internationally. Lesson 6 today is on rate buy down. So we're going to be talking about one of the most powerful strategies that you as a buyer can use to lower your payment. And so you may have heard of 2-1 buy down or paying points. You may not necessarily know what that actually means though. And so by the end of this lesson, you will know exactly how they work and how to use them to your advantage. So let's go ahead and jump in here. So before we dive into talking about what rate buy downs are and how they work, it's really important to note that these are one of the best strategies that you can use. In 2025, interest rates were pretty high, especially in the earlier months of the year, and the interest rate was really the biggest barrier for entry for buyers. And so a high rate can mean that you are basically priced out of being able to afford the home, or just your monthly payment might be too overwhelming. And so the rate buy down is here to give you some options, and they allow you to reduce your monthly payment by either temporarily or permanently buying down the interest rate, and then you can use those savings to make sure that you're able to pay the difference between renting for another year and owning your first home. So I think that this is a very powerful tool, and now let's go ahead and talk about how they work exactly. So with an interest rate buy down, it is exactly what it sounds like. It's a simple way for you to pay down your interest rate, make that interest rate lower, which means that your payment is going to be better. And so this is funded by either seller credits, maybe builder incentives, or you can actually pay this down yourself if you have the extra money after closing costs. And so the idea here is that you're going to spend some money up front, either yours or the sellers or the builders, to help reduce that rate, and then also in turn reduce your monthly payment. And so there are two options here. Primarily they have the temporary buy downs and the permanent buy downs, and so we're going to dive into both of those on the next couple slides. First up, let's talk about the temporary buy down. The temporary buy down is going to offer a lower payment for the first 1 to 3 years of your loan. Typically, the most common is a 2-1 buy down, but oftentimes you also be able to see a 3-2-1 buy down potentially. And so let's take the 2-1 buy down example first. So in year 1, your interest rate is going to be 2% lower below that market rate. In year 2, the interest rate is going to be 1% below market rate, and then in year 3, the interest rate is going to return to full market rate. And so this is similar with the 3-2-1 buy down. In year 1, you're going to have a 3% lower interest rate. In year 2, you have a 2% lower interest rate. In year 3, you have a 1% lower interest rate. And then year 4 through 30, that is when you're going to have that full market rate. And so this is really a fantastic option if you plan to refinance when rates drop, if that's kind of what is trending and what is expected. Or potentially if you know that your income is going to rise in the next couple of years, you're going to have some more money to actually help pay a higher mortgage overall. So let's take a look at an example of a temporary rate buy down. We're going to assume here a $400,000 loan and a 6.5% interest payment. And so that's going to put your payment at about $25.28 per month. There are some other factors you need to take into account, such as what your down payment is, as well as taxes, insurance, that can change that monthly payment. But for the sake of the example, that's what we're going to go with. So when you're using a 2-1 buy down, your interest rate for the first year is going to be 2% lower than that 6.5. So you'll have a 4.5% interest rate in year 1. That puts your payment at about $2,026 per month. That's a savings of over $500 per month in year 1, $6,000 that year alone. In year 2, your interest rate is going to increase by 1% to 5.5%, and so your monthly payment is going to be about $2,271, and so that's about $250 less than what your regular payment would be, and so that's another $3,000 saved in year 2. And then by year 3, your interest rate is going to return to the full 6.5%, putting your payment at that $25.28. And so overall, as I said, $500 per month in the first year, $250 per month in the second year. That's going to put you at about $9,000 or more in savings by doing this 2-1 buy down option. Let's move on to a permanent buy down. So permanent buy downs are slightly different than the temporary buy downs. With a permanent buy down, what you're going to do is you're going to pay what are called points. You're going to pay these up front to reduce the interest rate for the entire life of the loan. And so this can get kind of tricky, but a good rule of thumb is just that 1 point. Paying 1 point means that you're paying 1% of the loan amount, which is going to reduce your payment by about 0.25%, your interest rate by about 0.25%. So for example, on a $400,000 loan, 1 point is going to cost you $4,000, which will then bring down your interest rate permanently by about 0.25%. And so permanent buy downs make more sense if you plan to stay in the home for a long time and you really want some stability. Let's take a look at an example here for the permanent buy down like we did with the temporary buy down. So on the same $400,000 loan, you have that same starting rate of 6.5%. If you want to pay 2 points up front, then that means you're going to have to pay $8,000 to reduce your interest rate by about 0.5%. So that's going to take your interest rate from a 6.5% to about a 5.9%. It's going to bring your monthly payment down to $23.66. So you're saving about $162 per month for the life of the loan. And so the break-even point here is about 4 years. So if you plan to stay in the house for longer than 4 years, then the savings that you're going to get out of that actually outweigh that upfront cost of $8,000. And remember that you don't necessarily have to pay all of that yourself. If you want to, you can, but you can also have the seller contribute to that if they are open to it. So which one should you choose? If you're still kind of uncertain, then hopefully this will help clear some things up. So you should use a temporary buy down if you expect to either refinance in a couple years, because that's when you think that interest rates will be low enough. Typically, we recommend refinancing when interest rates are about 1% lower than what your actual interest rate is at the current time to make sure that the savings make sense. You also potentially would use a temporary buy down if you want to just kind of ease into home ownership with lower payments early on, but just be aware that those payments are going to increase as those years, year 2, year 3, start to catch up. If you're thinking about a permanent buy down, this is a really great option if you plan to stay in the home for a long term and you want guaranteed savings. And so it's going to be a higher upfront cost, but typically it's going to take you a couple years to break even. And then after that, you are saving money in the long term. So really the key here is matching your strategy with the timeline and your expectations for how long you plan to be in that home. Let's talk strategy real quick, a little bit more here. So in today's market, the smartest move really is to often combine these strategies with seller credits. And so sellers and builders typically are more motivated, especially when interest rates are high, because they realize that it's going to be harder for people to get into the home and actually make that purchase because they just can't afford it. And so many of them are willing to cover the cost of the buy down. And so this means that you can either reduce your payment temporarily or permanently without actually spending much money, if any, out of your own pocket. And so this is really important. I think that if you're looking at new builds especially, they're pretty good at covering things like this. Depending on the market that you're in, sellers also might be willing to do so. But if and when the market heats up and maybe you're in a seller's market in your local area, then this strategy can be a little more difficult because there's typically more competition. So sellers are less likely to want to offer more money to you if they don't necessarily have to. But when it's a buyer's market, this is a really good strategy, and I still think that regardless of a seller or a buyer's market, it is a strategy that you want to pursue with your agent. So the best buyers out there are not just shopping for homes, they're really shopping to find a creative financing solution that makes home ownership more affordable for them. All right, quick recap here. So rate buy downs are a tool that help you lower your monthly payment, and so you either have a temporary buy down or a permanent buy down. The way that these work is that you are paying some money up front during the process of purchasing the home, and that's going to lower your rate. And so the temporary buy downs are going to lower your rate for between 1 to 3 years. So depending on if it's a 3-to-1 buy down or 2-1 buy down, but then they will get back to that market rate. Permanent buy downs, on the other hand, are going to lower your rates for the life of the loan. And so in order to do a permanent buy down, you're going to have to pay points, and a point is typically 1% of the loan amount, and that's going to lower your interest rate by about 0.25%. So both of these options can save you hundreds of dollars per month and honestly thousands of dollars over time. The right choice really is going to depend on what your timeline is, what your budget is, and what your plan is for refinancing just overall. So I hope that this has been helpful. Congratulations, you have completed lesson 6, and with that you've also completed module 2 on financing with confidence. I hope you are feeling more confident now about different financing strategies and terms. In Module 3, though, which is coming up next, we're going to shift gears into House Hunting 101. So in this module, you're going to learn how to find the right home without losing your mind, because it can be a very stressful process. And so we're going to talk about how to shop smarter instead of harder. Please make sure that you subscribe so you don't miss it. Take care. Very quickly before you go, I just want to say thank you again for taking time to view these videos. I know the process can be very overwhelming, and so hopefully this is helping you feel more comfortable and confident in that home buying process. And so if you could do me a favor, I would really appreciate it if you could like and subscribe to the full Real Estate and Mortgage 101 series so you don't miss any more videos, because I have a lot more coming out, a lot more planned for you. And as a special treat, if you click on the link in the description box down below, you can access all of these Module 2 resources as well as other helpful guides and one-sheets, and that is my gift to you for free, absolutely, because I want to make sure that you are as confident and comfortable as possible with this process. Thank you again. Finally, once again, if you are interested in working with me, then I wanted to provide you with my contact information. So as I mentioned before, I am licensed as a realtor and a mortgage officer in Arizona and California. But if you are not in one of those locations, I do have referral partners across all 50 states and internationally. So feel free to shoot me a text, give me a call at the number on the screen, or send me an email, and I will do the best that I can to make sure that you are completely taken care of. Thank you so much for trusting me with this journey. Take care of yourself.